Hi everyone, with the continued declines we've seen in the tech sector, we thought we'd do a stock analysis on Salesforce, ticker symbol CRM. We really appreciate our viewers' interest and especially love hearing your comments, so keep them coming. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. So this video on Salesforce shouldn't be considered a recommendation to buy or sell the stock, but we hope as we evaluate this company that for educational purposes you'll understand a little better about how we think and understand the investment framework that we use here at YCG. Okay, so with that, let's dive into an analysis on Salesforce. Many of you already know what Salesforce is, but for those of you who don't, Salesforce is a provider of enterprise software delivered through the cloud, with a focus on customer relationship management. The company focuses on cloud, mobile, social, Internet of Things, and artificial intelligence technologies. The company's service offerings are configured and integrated with other platforms and enterprise applications. The company delivers its service offerings via internet browsers and on mobile devices. Its customer success platform is a portfolio of service offerings providing Salesforce automation, customer service and support, marketing automation, digital commerce, community management analytics, application development, IoT integration, collaborative productivity tools, and its professional cloud services. Salesforce changed the software industry in 2000, and since then remains the clear leader in Salesforce automation. The company has made some large acquisitions in the past. Demandware in 2016 for $2.8 billion, MuleSoft in 2018 for $6.5 billion, and Tableau in 2019 for $15.7 billion. And then, of course, the recent announcement of Slack, which will close next year in 2022 for $27.7 billion. All of the numerous cloud applications work seamlessly together in one integrated system, which continues to bring new clients and entrench existing customers further into the Salesforce's ecosystem. Okay, so with a better understanding of what Salesforce is, let's switch over to Refinitiv and look at the quantitative side of things. This is just really a basic analysis of Salesforce. Unfortunately, we don't have enough time here to cover the kind of depth we go into before deciding whether it's a stock suitable for client portfolios. But nonetheless, let's take a look. Okay, so this is Refinitiv. CRM is the ticker symbol. $208 is the current share price. You can see the two-day chart here, some very downward action, and it's kind of rebounding today, so that's good to see. Obviously headquartered in San Francisco, employees at 56,606, so very large company and growing. This is really interesting when you look at their capital structure. Their market cap's about $809 billion. And short-term investments or cash, $5.7 billion, and only debt of $2.6 billion. So well-capitalized, net cash position, which is what you want to see with these technological companies. And you've got debt to equity at 6.45%, debt to capital about 6% there. All right, so let's come down here. I like to look at things here on a calendar year basis. So looking here at enterprise value over revenue, we've got about 9 times in 2020, and then the company is forecasting to be about 7 times enterprise value over revenue, and going down to about 5.9 to about 5 times in 2023. Here we can look at enterprise value over Ebitda. I kind of like this metric because it's similar to a price over earnings ratio. And last year about 69 times, and the company's forecasting to make a lot more revenue. So about 24 times, going down to 19 times, 16 times in 2023. So that'll be interesting to see. So currently the PE, price earnings ratio, 50 times. So pretty expensive. The market kind of trading around 30, 35 times, depending on what metrics you use, and forecasting to be about 60 times, going down to 50 times in 2022 and about 40 times in 2023. Let's go down here to return on assets. So return on assets have been actually almost zero, so it's kind of irrelevant in the past, but returns looking to increase to about 6.5% to almost to 9% in 2023. Return on equity been about, well, again, almost meaningless in the past, but looking to increase that to about 8.8%, going to about 8% in 2023. Same with return on invested capital, about 8% looking forward. Let's look at the price action. So here we can see today's volume, about 4.8 million shares traded. Short interest is pretty low, 2.1%. Year-to-date performance has been pretty lackluster, down 6.46%. And you can see the one-year chart, though, is pretty strong. So just back, end of March, we were trading almost, a little below $160 a share. It got to as high as around, a little over $270, $280 a share. And now it's come down to where it is today, about $208 a share, trading at the end of the day today. All right, so let's go and take a look here at kind of the financial summary. Let's look at revenues. So revenues last year were 21.2 billion. Companies forecasting to have revenues of 25 billion in 2021 this year, growing to about 30 billion in 2022 and growing another 5 billion to 35 billion in 2023. Gross margin is something that we really like to look at. High gross margins are an indication of pricing power. And that's something that we really focus on here at YCG. And here, Salesforce is showing very strong gross margins, which is an indication of their pricing power. And no question that the larger their network grows, the more entrenched their customers become, and therefore their high switching costs really kind of enable the customers to stay and have Salesforce retain their customers and really make increased revenues from each customer. And Salesforce can increase their prices and those customers will stay. And so hence you see these very high gross margins, around 74% last year, growing to about 78, 79% in the next 3 years. So really strong pricing power demonstrating here in the numbers. You got EPS, about $4.40 here in 2020, estimated to be about $3.40 this year, to about $4 in 2022, and $5 in 2023. So companies expecting additional profitability as they move forward here. All right, I'm just going to scroll down here. About institutional ownership, about 82%. And let's go down to the segments. I always like to look at this segment here. So Salesforce, Platform and others, about 30% of their revenues. Their cloud service, forming about 25% of their revenues. Sales Cloud, about 24% of their revenues. Marketing and Commerce Cloud is about 15% of their revenues. And I would say that segment is actually not as sticky as the other platforms. But as customers use their whole integrative system, I think more customers are going to their marketing and commerce cloud just for the ease of automation when it comes to their marketing services. And then professional services, about 6%, small part of their overall revenues. So really nice diversified mix of their business segments there. Geographically, 70% of their revenues are coming from the United States. So predominantly United States business, although 20% from Europe, and then Asia about 9%. Nothing that jumps out as far as the top investors. It's just the large asset management firms and brokers. Really like the fact that Mark Benioff is still with the company. We love founder businesses. They definitely seem to have the long-term prosperity of the business in the forefront of their minds, and tend to not make bad short-term decisions. They tend to think more long-term, which we like to see. So peers, obviously Microsoft's a large peer, market cap of 1.7 trillion relative to the size of 1.89 billion, not 1.8, 189 billion of Salesforce. Interesting, here's another kind of price to earnings ratio. This is your enterprise value over Ebitda, looking at this year in 2021. And Microsoft's trading about 21 times, but with the sell-off in Salesforce, interestingly, it's trading at around 23.5 times. So the traditional price to earnings ratio is pretty high, but when you look at the enterprise value over Ebitda, pretty comparable to that of Microsoft. If you found this information useful, then please go ahead and hit the like button. It really does help with the YouTube algorithm analytics and can help our educational videos potentially reach more people interested in this kind of content. We've mainly focused on the numbers, but calculating valuation is the easy part. If the quantitative side made you rich, there'd be a whole host of accountants and mathematicians as billionaires. If you want to learn more about our entire investment strategy, we have a video that you can check out, this link up here. I think what would be helpful at this point is to look at the refinitive quantitative numbers again, but to put them through our YCG investment framework. Last time I used the spreadsheet, but I thought it looked a little discombobulated, so I prepared a few slides here to show. Okay, so here's the slide deck here. So let's take a look at CRM. Again, this is kind of a qualitative and quantitative analysis through the lens of YCG's investment framework. And we always want to look at kind of the competitive advantages of a business. And clearly, there's an organizational protocol and data network effect here with Salesforce, which is very, very strong. And once a customer comes on board and sees the integration of all these different types of services in the cloud and how they can automate their Salesforce systems, once a customer gets entrenched, there's a high switching cost. Even if there's another competitor that provides a service that's somewhat similar to Salesforce and it's cheaper, I think because of the high switching costs, the customers are going to be less likely to switch over to a competitor. So a very strong network effect. I said global network effect, no, but I think that's growing, right? You can see that with Europe and Asia being about 30%. So definitely more of a dominant US network, but I think that global segment's growing, and that will be very interesting to keep an eye on. And then obviously high switching costs with regards to Salesforce. All right, let's look at enduring pricing power. So I said probably, and we can see those in the gross margins, right? So very strong gross margins. The key word here is enduring. And in the tech sector, you have incredible amounts of competition. And the question is, could other competitors come and provide other automation services, AI, and CRM systems that compete away those high profit margins in that industry? And so that I think is still kind of out with the jury still, but probably has enduring pricing power with what we're seeing right now. Morningstar has a very wide moat rating. Again, think of a castle, right, with the moat around it. Again, once a customer joins with Salesforce, very, very wide moats and protecting and retaining those customers. So definitely a wide moat rating. Capital allocation, Morningstar rates them as standard and fair value uncertainty as medium. And obviously it's a large cap growth category stock. So let's take a look at the numbers again. All right, so trailing 12-month gross margins, about 75%. They're estimated to grow further to 79%. You got trailing 12-month operating margins at 2%, and returns on capital employed very low at 1%. So high growth company, not a high profitability company right now, but again, they're investing a ton of money in acquisitions, and that's been their strong strategy. And some of the acquisitions have been very, very, very strong. The slack is still out with the jury as far as whether they overpaid or not, but it does seem to be an acquisition that seems very additive to the overall services that Salesforce provides. ROTA's about 7%, expected ROE at about 11%. Notice again, negative net debt, so they have a net cash position, which is always great to see. Next, revenues estimated about $25 billion. And then just different valuation metrics here to see. And again, I think YCG would consider this as an investment. I think the thing that concerns us though is one, valuation, and then also just the serial acquisition strategy. Acquisitions can be good if they're additive, but sometimes they can be CapEx expenditures in disguise. We're just kind of hesitant about how acquisitive Salesforce has been and the premium prices that they've been paying and continue to pay gives us pause. So let's do a stock comparison. So I've looked at here, created a table showing Salesforce here. The price is at $207.84. Earnings per share over the next 3 years is on average about $4.50. And let's assume that they pay out about 90% of their cash flow, their earnings, out to shareholders. And you as an equity holder are the shareholder and entitled to those earnings. So your shareholder yield will be about $4.13. If you divide that to the price right now, you're getting about a free cash flow yield of 1.5%. And we always look at terminal growth rates here at YCG, and I know Salesforce is growing around 20%, but long term, like 20, 30 years, terminal growth rates tend to come down to about 5%. So we want to be conservative and say, all right, if we add the free cash flow yield with the growth rate, you get about a forward expected return of about 6.4% with Salesforce currently. What this does, it shows you that you're really banking on the growth working out. Obviously, this forward rate of return could be much higher if the company continues to grow at 20%. But as the company gets larger, those growth rates come down. And so, again, you're focused more on the growth side when you're looking at a business like Salesforce. Now, looking at Microsoft, trading at $235 a share, their earnings per share is $7.74. Again, if we use and assume the same payout, about 90%, your shareholder yield is about $6.96, which actually yields a free cash flow yield of about 3%. So twice as much as what you're getting with Salesforce. And if we, again, assume the same growth, about 5%, your forward expected return here on Microsoft is higher at about 8%. So kind of interesting comparison to look at. Again, you want to know where the growth is coming. And I think that's the key that you want to take a hold of. So anyway, this is a little background on our company right here. Okay, so I want to kind of go through a growth multiple exercise right here. So let me switch over here. Again, let's assume $1 of earnings and you're growing, and I'm going to actually double the growth rate here. I know we assumed 5% growth rate with Microsoft and Salesforce, but let's double that because they are technology companies and they're growing very fast still. But if you pay a multiple of 58 times, and let's say the market drops and that multiple now drops down to 20, look how many years it takes for you to make up. It takes you 11 years to make up for the high price that you paid for that $1 of earnings. If we switch now back down to what Microsoft was trading at, which is about 35 times, you can see that it only takes now about 5 years to make up what you paid for those $1 of earnings. And I think that's why we pay attention to valuation. Growth rates are great and we love growth, but you got to know what you're paying for that growth, how much cash the business generates, and what price you're paying for that cash, and when you actually anticipate seeing that cash. And the acquisition strategy of Salesforce definitely clouds that clarity when you're looking at the stock. But there's a look at the numbers. Hope that was helpful to you. So what are your thoughts on Salesforce? We'd love to hear your opinions in the comments section. We currently don't own Salesforce in client portfolios, but you can request a complete list of all securities recommended by YCG in the last 12 months by reaching out to us. Thanks for joining us today. Check out one of our other videos and we'll see you next time.